529. College plans are tax-advantaged savings accounts specifically designed for future education expenses. Contributions grow tax-free, and withdrawals remain tax-free if used for qualified education expenses, including tuition, fees, books, and even room and board. There are two types of 529 plans: prepaid tuition plans and education savings plans. Prepaid tuition plans allow families to purchase credits at participating colleges and universities at today's rates, which helps hedge against tuition inflation. Education savings plans, on the other hand, are investment-based accounts where funds can be used at any eligible institution nationwide. Families can contribute to 529 plans, up to a state-specified limit, and contributions are not tax-deductible at the federal level, though some states offer tax deductions or credits for contributions. While 529 plans are traditionally used for college expenses, recent changes allow up to $10,000 per year to be used for K-12 tuition at private or religious schools. Additionally, the Secure Act 2.0 allows unused 529 funds to be rolled into a Roth IRA for the beneficiary, providing another avenue for tax-advantaged savings. While 529 plans offer significant benefits for saving for education, they also have drawbacks to consider. One of the primary disadvantages is the limited flexibility in fund usage. Withdrawals must be used for qualified education expenses, such as tuition, fees, books, and room and board. If funds are withdrawn for non-educational purposes, they incur income tax and a 10% penalty on earnings, reducing their overall value. Another drawback is the restricted investment options. Most 529 plans offer a selection of preset portfolios, rather than allowing complete control over individual investments. This can limit the potential returns for account holders who prefer a more active investment strategy. Additionally, investment performance varies based on market conditions, and there is always a risk of losing value depending on the selected portfolio. Financial aid eligibility may also be affected by 529 plans. Since these accounts are considered assets of the account owner, typically the parents, they are factored into the expected family contribution, EFC, when applying for federal financial aid. This can reduce the amount of aid a student qualifies for compared to other savings vehicles that may have a lesser impact. Furthermore, state tax advantages differ depending on location. While some states offer tax deductions or credits for contributions to 529 plans, others do not provide any benefits. The most common concern is what happens if the beneficiary does not need the funds. If a child decides not to attend college or receives a scholarship, families may need to change the beneficiary to another eligible family member or accept the taxes and penalties on non-qualified withdrawals. Despite these drawbacks, careful planning and understanding of the rules can help families maximize the benefits of a 529 plan. Achieving a better life experience, ABLE. Accounts are tax-advantaged savings accounts designed to help individuals with disabilities and their families save for qualified disability expenses without affecting eligibility for critical benefits like Medicaid and supplemental security income. These accounts were established under the ABLE Act of 2014 and provide an opportunity for individuals with disabilities to achieve greater financial independence. To qualify for an ABLE account, the individual must have developed their disability before the age of 26. Family members, friends, and the beneficiary themselves can contribute funds to the account, up to the annual contribution limit, which aligns with the federal gift tax exclusion amount. Contributions to ABLE accounts are not tax-deductible at the federal level, but may be deductible for state tax purposes, depending on the state of residence. The funds in ABLE accounts grow tax-free, and withdrawals for qualified expenses remain tax-free. Qualified disability expenses include costs related to education, housing, transportation, employment training, assistive technology, personal support services, healthcare, financial management, and funeral arrangements. These accounts provide flexibility and financial security, allowing individuals with disabilities to cover essential expenses without jeopardizing government benefits. However, ABLE accounts have some drawbacks. One major limitation is the eligibility requirement, which restricts these accounts to individuals whose disabilities began before age 26. This excludes many people who may develop disabilities later in life. Another drawback is the annual contribution limit, which may not be sufficient for individuals with significant financial needs. If an ABLE account balance exceeds $100,000, the beneficiary's Supplemental Security Income (SSI) benefits may be suspended until the balance is reduced below that threshold. This could impact individuals who rely on SSI benefits for daily living expenses. Investment options within ABLE accounts are often limited compared to other savings vehicles, making it difficult to customize investment strategies. The fees associated with ABLE accounts also vary by state, and administrative costs may reduce overall returns. Upon the death of the beneficiary, some states require remaining funds to be used for Medicaid reimbursement, which could prevent heirs from inheriting any remaining savings. Despite these drawbacks, ABLE accounts remain a valuable financial tool for individuals with disabilities, providing tax advantages, flexibility, and the ability to save for essential expenses while maintaining eligibility for government assistance. Children's savings accounts are financial tools designed to help kids develop good saving habits while earning interest on deposits. These accounts are typically held in the child's name and jointly managed by a parent or guardian. They provide an opportunity to teach financial literacy, encourage responsible money management, and establish a foundation for future financial security. Many banks and credit unions offer children's savings accounts with incentives such as higher interest rates, bonus deposits, and educational resources. The best options include accounts with no monthly fees, competitive interest rates, and easy access to funds. Some top choices include high-yield savings accounts, online banks with strong interest rates, and credit unions with special youth savings programs. Certain banks provide rewards for consistent saving and additional benefits for parental involvement in financial education. Despite these advantages, there are drawbacks to consider. Some children's savings accounts require a minimum balance to earn interest, which may limit accessibility for families who cannot maintain a high balance. Interest rates on traditional savings accounts tend to be lower than other investment options, potentially reducing overall growth. Additionally, while these accounts are liquid, excessive withdrawals may lead to restrictions or penalties depending on the bank's policies. These accounts lack tax benefits compared to specialized savings vehicles like 529 plans or custodial accounts. Since children's savings accounts are not investment accounts, they do not offer significant long-term financial growth compared to stocks or other investment tools. Therefore, you will have to either teach your child about investment accounts or open an additional investment account for them to invest long-term. Roth IRA for Children is a custodial account designed to help minors start saving for retirement early. It offers tax-free growth and withdrawals, making it an attractive option for long-term financial planning. To open a Roth IRA for a child, the minor must have earned income, such as from babysitting, mowing lawns, or other jobs. The contribution limit is up to 100% of the child's earned income or $7,000 annually, whichever is less. Parents or guardians act as custodians, managing the account until the child reaches adulthood, typically at age 18 or 21 depending on state laws. The benefits of a Roth IRA for children include the ability to withdraw contributions at any time without taxes or penalties, providing flexibility for emergencies or qualified expenses like education or a first-time home purchase. Earnings can grow tax-free and be withdrawn tax-free in retirement, provided the account has been open for at least 5 years and the owner is 59.5 years or older. Early withdrawals of earnings may incur taxes and penalties unless they meet specific exemptions. Starting a Roth IRA early allows children to take advantage of compound interest over decades, potentially building substantial wealth. For example, a child who contributes $2,000 annually from age 15 to 18 could see that amount grow significantly by retirement age, assuming consistent investment returns. The key drawback of a Roth IRA for children is that the money cannot be touched until the child reaches retirement age. Early withdrawals of earnings will incur taxes and penalties unless they meet specific exemptions. These factors make it important to weigh the benefits against the potential drawbacks when considering a Roth IRA for children. Custodial accounts offer unique advantages over other savings options for children, making them a compelling choice for families who want flexibility and broader financial benefits. These accounts, such as Uniform Gifts to Minors Act, UGMA, and Uniform Transfers to Minors Act, UTMA accounts, Allow parents or guardians to set aside assets for a child's future use without restrictions on spending. Unlike specialized accounts like 529 plans or ABLE accounts, custodial accounts do not limit the funds to education or disability-related expenses. This flexibility makes them superior for families who want to provide financial support beyond tuition or medical costs. One major advantage of custodial accounts is that they offer broad investment opportunities, allowing account holders to invest in stocks, bonds, mutual funds, and other assets. Unlike children's savings accounts, which typically offer lower interest rates, custodial accounts can take advantage of market growth, leading to higher potential returns over time. Another benefit is that custodial accounts allow parents to transfer assets to their children without establishing a trust, which simplifies financial planning. Compared to Roth IRAs, which require earned income for contributions, custodial accounts do not have income requirements, making them more accessible. These accounts are particularly useful for families who want to transfer wealth efficiently without worrying about restrictions associated with tax-advantaged plans like 529 or ABLE accounts. However, custodial accounts do have tax implications, as earnings are taxed at the child's rate, which may be beneficial compared to higher tax brackets for parents but could still trigger the kiddie tax if the income surpasses a certain threshold. Additionally, custodial accounts are considered the child's asset, which can impact financial aid eligibility when applying for college. Unlike 529 plans that are treated as the parent's asset with lower financial aid implications, custodial accounts are assessed at a higher rate, potentially reducing the child's aid eligibility. Despite this drawback, custodial accounts remain one of the most flexible and versatile savings tools for children's financial security. They provide the ability to save for diverse future needs beyond education, while offering strong investment potential. Parents should weigh their priorities and financial goals when deciding which savings vehicle to use. If the goal is broader financial support with fewer restrictions and investment growth potential, custodial accounts stand out as a superior choice. By taking advantage of these accounts early, families can build substantial wealth for their children's future while maintaining control over how funds are managed until the child reaches adulthood. Each of these savings vehicles offers unique benefits and considerations, making it essential to evaluate which option aligns best with your financial goals. Many families choose a combination of these accounts to diversify their savings strategies. Some prioritize 529 plans for education, while others use custodial accounts for flexible financial support. HSAs and Roth IRAs can provide long-term advantages, especially for future healthcare and retirement needs. Regardless of the chosen savings method, the key is to start early and contribute consistently. This ensures a strong financial foundation for children as they grow and transition into adulthood. Check out our other videos to learn more about how to become financially free.